allow me to open an Excel workbook. Let me open an Excel workbook. It will open shortly. Let me share my screen. You know, you having done SBL, some of you are familiar with mergers and acquisitions, the basic strategic implications of acquiring firms, or combining or merging with other firms, why we do that, and a lot of other things. Now let me open a spreadsheet here. You have started doing assignments, right, Paddy?
Yes, it's work in progress.
Yeah, please do the assignments. I'll send you examiner's report. Remind me to send examiner's report in the groups, in the WhatsApp group after the lecture. Please remind me, because as soon as I've left the study room, I won't entertain anything to do with school. So you need to remind me as soon before I leave the study room, because I leave everything in the study room. I leave my phone in here. I leave everything. When I go to the dining, I'll be myself, and I'll actually, attend to any queries tomorrow 9:30. So I won't be able to do that.
So say, before I forget, we didn't get the marked copies of the first assignment we did, so that probably you try to gauge where we didn't do well. And
the same questions in the first assignment are in the assignments. So don't worry. The same questions in the first assignment are in this assignment. So don't worry. You come across them. So don't worry about that. Who is this? Someone is trying to call. Let me check who the person is. Hopefully she'll be able to join. It's Katrish R. Let me try to add this person to our chat. Katrish R. Okay, so this one. Okay. Right. So today we want to discuss mergers and acquisitions. Quite a lot of discussion concepts. Remember, topics are not always based on computations. It starts from being, they start from being theory heavy, and then you escalate it to computations. So mergers and acquisitions is our today's discussion. Let me write this. Please feel free to participate, because we want to quickly go over this and finish it. Mergers and acquisitions. Before I proceed, be prepared to finish today's lecture, say at 9:30, not 8:30, 9:30, because we want to do a 50-mark question at the end of this discussion. Mergers and acquisitions. You know, from strategic business leadership, SBL definition, mergers and acquisitions is a form of external growth. It's an external growth mechanism which involves acquiring a controlling interest in another entity, or you can just merge entities. So there's acquisition, where you actually buy a controlling interest, and there's merger, where you with a merger you don't buy, but you just combine the existing entities. Yes, Innocent. Yes, listen, Ratanga. In a network, can you try again? Okay, cool. Right. Then let us start with advantages. The advantages of mergers and acquisitions. Quite a lot of advantages. You can make use of the chat feature to type advantages. Then I will visit those advantages later. and disadvantages. So you say advantage, disadvantage, or you can unmute and talk to me. Actually, don't make use of the chat feature. Just unmute and talk to me. What is the benefit of merger and acquisition? So we have number one, it helps the firm to spread risk. You know, it's amazing how you forget stuff from earlier subjects. It helps the firm to spread risk. Another advantage is enhances economies of scope. It enhances economies of scope. What do you understand by economies of scope? May you mute, guys, when you feel like you have got background noises. Just mute. Sorry, Lieutenant, I'm muting you. It's too cool. All right, don't worry, you still hear me. Economies of scope. You know, economies of scope meaning ability to sell, ability to offer wider range of products, to offer a wider product range. We call this economies of scope. And also, another benefit of mergers and acquisitions is to reduce competition. Use mergers and acquisitions to reduce competition, like horizontal integration. We call this horizontal integration. You know, to reduce competition. Another benefit of mergers and acquisitions.
Sorry, sir.
Yes.
Economies of scope and economies of scale, are they in one bracket or they are split points?
There are two different points. Economies of scope simply means the scope or the product range of your business has increased or has widened. Economies of scale means costs have been reduced. Economies of scale has to do with average costs. So you call these synergies. That's another advantage of mergers and acquisitions. It's synergies. And there are various types of synergies. There is what is called cost synergies. Cost synergies. That's economies of scale. Economies of scale. It's a cost synergy. You know, I'm sure you are answered on that one. Then there is product synergy. There is technical or managerial synergies. Technical or managerial synergies. What are technical or managerial synergies? It's like after you have merged as a business, you know, one firm can exploit competencies of another. Imagine a situation where post office merges with CBZ Bank. Post office combines with CBZ Bank. There's one party which stands to gain. In this case, post office stands to gain because post office doesn't know quite a lot of things, even how to maintain a queue, how to manage queues. Post office will gain a lot of that, and other competencies which CBZ has, which post office doesn't have. And after the merger, these will be shared. And there's what is called operational synergies. Operational synergies. You know, they occur also as a result of merger, e.g., removal of duplicated processes. That's operational synergies. When duplicated processes are removed, you know, if companies merge, we need one finance director, not two. So if this alignment of duplicated processes and streamlining of these redundant processes which are duplicated, it's a benefit of mergers and acquisitions. Another benefit of mergers and acquisition is is, you know, all these should be disclosed, like technical synergies, cost synergies, operational synergies. There's also quite a lot, like it helps the firm. It helps the firm create value to shareholders. Oh, it's not under synergies. Okay. Let me say the merged firm may have a better strategic position, for the creation of value to shareholders. You know, there are instances where you are unable to exploit opportunities, not because you don't know how to exploit them, but because of your size. After mergers and acquisitions, when your size has become blossomed, you may stand a better chance to seize on opportunities and create value for shareholders. Disadvantages of mergers and acquisitions. Disadvantages. You know, mergers and acquisitions has got advantages, but it also does have some disadvantages. Someone is typing something. Well, it's not someone typing. Disadvantages of mergers and acquisitions. Quite a lot. You know, mergers and acquisitions are like, oh, do you want me to say it? Let me not say it. I will say it at a particular point. Do you want me to say it, Patty? Mergers and acquisitions, you know, they've got some disadvantages. Another is
you can skip that one.
Synergies may not materialize as planned. Synergies may not materialize as planned. So what I meant was, mergers and acquisitions are like when you are getting married, or you are not, you are okay. When you are divorcing, we shall discuss that when you are talking of unbundling. For now, we want a situation which is analog. It's an analog to those guys who are getting married. There are instances when synergies, the promised benefits may not materialize as planned. You know, when you want to merge, there's a lot of truths and there's a lot of lies involved. And in final analysis, the expected benefits may not come out right. No wonder why there's need for due diligence. I shall discuss with you later on that one. Another is mergers can be contested legally, or otherwise. You know, these mergers they can be contested. People can actually contest merger. Well, you may. Well, it's not always that if you try to merge, government will agree to that. Government may actually object to mergers and say this is anti-competitive and it results in creation of monopolies, which are against public interest. So they can actually objectively they can contest or object to the merger. Right? Another is it may be difficult to harmonize culture and operating policies. Culture and operating policies of the merged firms. Very difficult to harmonize culture and operating policies of the merged firms. Even when individuals get married, there are instances where you might find it difficult to harmonize your culture and operating policies. No wonder why we say Urora Naiwe Matongo. Even firms, the analog is not exact.
Say, may you tell the Catrice that she's on video?
Ah, well, I'm sure everyone is seeing my screen. Are you not seeing my screen, buddy? Well, who is that? Okay, you can mute your videos, but I'm sure I'm sharing my screen. Right, it may be difficult to harmonize culture and operating policies of the merged firms. So you have that. There are other disadvantages. The other disadvantage of mergers and acquisitions is, it may result in creation of monopolies. It may result in creation of monopolies, which is against public interest, These are disadvantages of mergers and acquisitions, especially an element of some mergers may not materialize, some synergies may not materialize as planned. There are instances when when you are planning to merge, suppose you are planning to buy Atlan's resources. Atlan's resources may promise you quite a lot. So say, you want to buy Atlan's resources? What is our value? Our value is so much. Don't worry, when you buy Atlan's resources, revenue will increase by a lot. It is always customary that when a company wants to be bought, it does what is called make up, to spice things up so that they are appealing to the acquirer. But you know what may happen? After the merger, you may realize that, I was deceived. And at personal level, we call that romantic fraud, where you fall prey, you fell prey to make up, and you realize that, that was just make up at the end of the transaction. We call that romantic fraud. And there are legal remedies for that. But when it comes to mergers and acquisitions, there's no remedies for that. When you buy an underperforming firm, but you could not do your due diligence at the time of acquisition, we don't give you an excuse for that. So these are some of the benefits and mergers of mergers and acquisitions. Let us now discuss target selection. Oh, fantastic stuff. Mitigating the risk of acquisition failure. Mitigating the risk of acquisition failure. Mitigating the risk of acquisition failure. That's target selection. Quite plenty of things that we can discuss on that. What is important is, when I was dating my wife, I had a list of things to look for. I said, I want to get the right person, so I had a list of things to look for. And when I found one with those, the person became my wife. A company should also do the same. You don't fall into mergers and acquisitions. We don't want you to fall into it. We want you to enter into it with your eyes open. Otherwise, you run the risk of acquiring a firm which will result in a disaster. And as stakeholders or as shareholders, we feel that the reason why you enter into mergers and acquisitions is to create value. And when we realize that value is not being created, we begin to poke our nose into your affairs. You get that? So Under normal circumstances, from our studies elsewhere, we use SAF approach. To mitigate the risk of acquisition failure. To make sure that we evaluate, SAF approach is used to evaluate the potential target. Evaluation of the potential target. You go by SAF approach. Evaluation of the potential target. Now, here's the deal concerning SAF approach. You go by suitability. Those who have taught SBL, they already know that. But if you have forgotten, suitability simply means you are simply saying whether the acquisition makes sense, whether the acquisition makes sense or not. That's what we are looking for. Another, you are looking for whether the business models of acquirer and target can be harmonized. The business models of the acquirer and target can be harmonized. That's another. You are looking at whether the decision to pursue acquisition as a strategy is supported by those charged with governance. This is what we look at. You are not allowed just to fall into acquisition. No, you enter into acquisition. It's important. So you look at, is it suitable? When we are saying it's suitable, we are saying, does it really make sense? Or can these businesses really be merged? For example, we do have a business like Econet, like Miku's Hotel. Can you merge Miku's Hotel with Mambo's Chicken, for example? That's a disaster, isn't it? How would you make such businesses? The acquisition does not even make sense. There are acquisitions which fall short of the sensibility test. And according to SAF approach, such acquisitions are not suitable. So that's what you do when you are evaluating merger and acquisition. You test the sensibility test. Another is acceptability. Even if you want to get married, you say vanhu. That is acceptability. Don't just do something because you are saying it's for me. No. Acceptability meaning stakeholder impact assessment test of the proposed merger. Stakeholder impact assessment test of the proposed merger. Ability. Acceptability, we are saying, how will the proposed merger likely to impact on stakeholders? That's the bottom line. That's acceptability. It's a stakeholder impact assessment test of the proposed merger. If a company wants to get acquired and there's a potential for acquisition measures, what we need to understand is, us as shareholders, you need to convince us that this thing is going to pay the benefits. We are like Nigerian in-laws. If you bring your suitor to Nigeria, we always watch Nigerian movies. They would say, what do you do for a living? You know, it's quite amazing. It's an automatic question. We want to see that after the merger, are we better off or worse off as at the end of the merger than we were at the beginning? A merger should create value. If shareholders cannot see any value created from the merger, clearly we are wasting. It's not a strategy to pursue. So in SBL, we just discussed the strategic sense of it. In AFM, we need to discuss the financial case of it. In other words, are the stakeholders likely to enjoy the expected benefits from the merger? So what really do we mean when we are saying acceptability? By acceptability, we are actually saying impact of the merger on stakeholders. Another thing is it involves, that's another point, it involves undertaking a before and after analysis. Before and after analysis of the relevant metrics, you know, before and after analysis of the relevant metrics, such as you know, share price, comma, EPS, comma, revenue growth, etc. That's what we mean by acceptability. Is this measure acceptable to stakeholders? In our Shona variant of it, you always hear ladies say, I had to let go this person because I realized the person has no future. What does this mean? What does it mean when someone is saying a person has no future ever? Can you talk to yourself? You hear people say, each person, ladies, you say it most. They say it most often. You are no longer saying it because you have already entered into this thing. What I'm saying is those, or in your past, you would say the person has no future. What does that mean? Talk to yourself. Okay. Let me not say much anyway. But do you want to spice it up? What does that mean when you are being referred to as a person who doesn't have a future?
I think a person who is referred to as one who doesn't have a future, probably in terms of non-alignment of goals. There's no goal congruence between the two parties, and probably
Yes.
the other party will be looking at your potential. Probably from his or her point of perspective, you don't have the potential to make it in life.
Yes. So the aspect of a person not having future, it's not a derogatory term. You can't say I'm being denigrated when I'm being referred to as someone who doesn't have a future. The issue is, if I'm saying you don't have a future, what I'm saying is I have considered before and after, and I'm realizing that I am worse off at the end than at the beginning. This is what must be considered when you are selling off the merger to affected stakeholders. There are stakeholders, there are shareholders of the target, meaning the company you want to acquire, it has got shareholders. There are shareholders of the acquirer. It is your ability to make sure that the merger is meeting the legitimate expectations of these stakeholders in terms of value that warrants you to go ahead with the merger. And then another is okay, so that's acceptability. Acceptability. This point I like it ever. It says acceptability also involves an evaluation of the assumptions underlying the evaluation of the assumptions underlying the proposed synergies, and the extent to which such synergies will be realized. Such synergies will be realized. You know, that's acceptability. Acceptability means don't be lied to. You can't have a situation where someone is saying, if you acquire Atlan's resources, we will have this, we will have this, we will have this. All these are called promises or synergies. Acceptability looks at, are these synergies likely to be realized? In other words, aren't they amplifications or exaggerations of the expected benefits? You need to figure out, can you imagine, suppose at Apple's resources, I'm already failing to operate as a going concern. Look at it at that example. I'm already failing to operate as a going concern as Atlan's resources. And then you propose to acquire Atlan's resources. And I begin to say, look, you know, it's Atlan's resources. I am failing to get tenders, but once you acquire us and you give us managerial positions in the merged firm, we are likely going to get A, B, C, D. You know, you need to evaluate, are those likely benefits to be, are they likely to be like reasonable in light of the current context facing the firm? You need to consider this. Another is feasibility. Feasibility looks at skills and competencies. Feasibility looks at skills and competencies. Skills and competencies. We call it capability. And looks at skills and competencies and resources. So you can mute, just mute when you feel like you've got background noises. And resources, that's capacity necessary to execute the merger. You know, necessary to execute the, that's feasibility. Feasibility looks at, have you done it before? Do you have skills and competencies? So it's about evaluation of previous measures to see whether these measures have performed well. You can't go on acquiring if those acquired are failing to operate well. You know, at the situation yekuti unaacquire kunge without taking any offense, unaacquire kunge munhu wekwamarangi wekuti anogona kukuacquira 20 wives pasina kana mwana 1 ari kuenda kuchikoro, and you'll be shocked kuti unoona umwe achiroorwa futi. What the heck is that? Feasibility means you must have skills and competencies on the part of the acquirer and the acquired to effectively execute the merger. Go ahead, Paddy. Well, because it's that vague, let me leave it that way. That's the bottom line. Feasibility, if you want to test feasibility, look at the previous acquisitions. Were they successful? If not, what were the reasons for them not being successful? And then assess those reasons before you proceed with additional acquisitions. That's the issue there. And then another issue is, you know, another issue is another issue. I don't want to read to write to I don't want actually to give you this to write it. It is called the superior knowledge argument. It is called the superior knowledge argument. Let me just say it in words. We don't want a situation where a firm can merge another firm, but it does not know how to unlock value. You know, Paddy, for you to merge, you must have superior knowledge, which the target does not have. Otherwise, if you merge and you don't possess unique knowledge, which the target doesn't have, chances are you may fail to unlock value for shareholders. We call that superior knowledge argument. You know, suitability, acceptability, and feasibility and superior knowledge argument, collectively, we call that due diligence. Due diligence means don't fall into mergers and acquisitions, but enter into it with your eyes open. We don't want people who fall, who fall in love, for example. I fell in love. No, you don't need to fall in it. You need to enter in it with your eyes open. And how do you go about it? You have your blueprints of suitability, acceptability, and feasibility. So we have discussed these. Now continuing. Defensive tactics. Please pay attention. This is this easy. Defensive tactics. You defend yourself against, open brackets and say, against hostile takeovers. Against hostile takeovers. There are defensive tactics against hostile takeovers. Let us see if that is a subheading. Defensive tactics. Suppose you want to be acquired and you feel like you don't need, you don't want. How do you defend yourself against this crazy pursuit? How do you go about it? As you say, I teach you everything. That's the beauty of being your say. I teach you guys everything. There's a hostile takeover. A pursuit, a company which is trying to be acquired does not want to be acquired. How then do you defend yourself? Quite a lot. You can defend yourself as Pac-Man defense. You still remember Pac-Man, a game which is called Pac-Man. It's like mounting a counter takeover bid. Mounting a counter takeover bid. That's Pac-Man defense. And then there is a revaluation of assets. Revaluation of assets. It's a form of defense. Revaluation of assets. A revaluation of assets is what ladies normally do. A lady will be like used to eat sadza and maguru and mazondo but the moment you propose, the person is no longer even the person. The basic meal that the person now needs is KFC. You wonder, you have been eating sadza and maguru, but now all of a sudden you are now starting from KFC and above. It's not a train smash. It's not a bad thing to do that as ladies. Say is telling there's what is called revaluation of assets. You need to make yourself expensive so that the suitor must pay for that continued pursuit. In the absence of the same, that's a revaluation of assets. And another is as a form of defensive mechanism, it's let me say crown jewel defense. Crown jewel defense. Now, crown jewel means selling a division, asset or subsidiary, which attracting predators, which is attracting Predators. That's crown jewel as a defense. You are selling that which is attracting predators. Let me put it in brackets and say, crown jewel as a defense. Crown jewel as a defense mechanism requires shareholder approval. Crown jewel as a defense mechanism requires shareholder approval. You get that? So important. We can't have a situation where, like, I'm a shareholder. Here is a company which I am a shareholder. It has got some inquiries from people who want to buy it. A lot of people want to buy this company. Now look at it this way. Instead of you accepting that potential acquisition, you decide to sell assets which are attracting those bidders. Are you noticing that if as directors we leave you unchecked, you may actually erode shareholder wealth? Suppose the Atlantis has got a mine in Kwekwe, and companies are bidding to buy Atlantis because they know that we have a mine in Kwekwe. And you as directors then decide to sell that mine in Kwekwe. You know, it might look like you have prevented a major acquisition, but ideally, you might also cause erosion of shareholder wealth. So, crown jewel as a defense requires you to have shareholder approval before you pursue it. You get that? So there you go. And then we have another defensive tactic. It's poison. It's poison pill. Poison pill. You know, poison pill means making the acquisition expensive to the bidder. Acquisition expensive to the bidder. That poison pill. When we are saying bidder, we are saying that hostile person, one hostile company. How do you do poison pill? Let's say e.g. bonus shares. Issuing bonus shares. Another poison pill approach is stock splits. Another poison pill approach is golden handshakes. Like awarding huge remuneration packs to directors. Huge remuneration packs to directors. Called golden handshakes. What the heck is that? What is happening with this? Awarding huge remuneration packs to directors. Awarding huge remuneration packs to directors. So there you go. Another. Oh.
Sorry, sir.
Yes.
So I just want to ask on that golden handshake with the example which you gave of awarding huge remuneration packs to the directors. Of what benefit will it be should the takeover go ahead? Is it not that they're eroding the operating capacity of the business?
Yeah, but even though they are eroding it, but in a lesser proportion compared. But remember, they are trying not to be acquired. So they are just trying to make it expensive to the bidder. So the bottom line is, if we increase remuneration packages to outgoing directors, like we say, it's not like we have paid them per se. We are simply saying, because normally the bidder would retire directors. The current directors of the target, they have to be retired. So what we are actually saying is, we then have to say, if you are to be retired, this is your entitlement. In which case, the potential bidder becomes expensive to that. though it will still be expensive to us, but in the meantime, we have avoided a takeover bid. That's the bottom line. We have avoided an immediate takeover bid. Yes. So that's these are called poison pills. You are simply trying to make the takeover less attractive to the bidder. Say has given you an example of bonus issues. Bonus issue. Can you imagine a situation, Paddy? You are dating someone and then you say, let us meet for lunch, for dinner. Let us date for a dinner for what? And then the person brings 8 friends. 8 friends of her friends. Zvinoitwa nemunhu anotya Mwari here izvozvo. Tunounza 8 my friends tatati tiri kusangana kudinner. So that's what is called. That's what is called poison pill. You are making it now expensive to the bidder. If you issue bonus shares, you are simply saying you wanted to buy at $4 per share, and now we have issued bonus shares. Can you now buy at $4 per share? So bonus shares and the stock splits have the same implications there. So these are some of the defensive tactics. They are not all. There are others which are called skip a line, like white knights. White knights. White knights simply means engaging a friendly bidder to scare away. Engaging a friendly bidder to scare away a hostile bidder. That's white knights. White knights, it's like it's comparable to a lady putting her brother on her status and say, I love you so much, we want to spend the life together, but the person is her brother. And then if you were in a hostile pursuit, you'd say, what the heck is this? So in so doing, the person has prevented a hostile takeover by engaging this particular issue, which we refer to as white knights. So in a revision month, I'm busy answering to questions at the same time, but let me try by all means to focus on this. Remember, today, be prepared to end our lecture be prepared to end our lecture at 9:30, guys, because we want to do a question at the end of this. And then that's hostile takeover. Another discussion item is regulatory framework. Regulatory framework. When we are talking of regulatory framework, we are actually saying what are the framework for mergers and acquisitions? In our social interactions, you don't marry someone below 18. It's not allowed. You don't force marriage. It's not allowed. Even companies, they have to follow the same regulatory guidelines. And we call these regulatory frameworks. And here are the regulatory frameworks at our disposal. There are plenty of them. What we are going to discuss here is the international, those regulatory frameworks which are multi-jurisdictional in terms of their coverage. And there is one which is called Principle of Equal Treatment. Principle of Equal Treatment. Principle of Equal Treatment. This states that the acquirer must treat all shareholders of the target equally. All shareholders of the target equally. That's the principle of equal treatment. Equally, by equally means same terms. Same terms. You need not to favor some and then put up terms which suppose you want to say, I will pay $20 for the first 10% of shareholders on a first come, first serve basis. It means you are saving some, you are leaving out some. So you are violating the principle of equal treatment. 2, there is what is called squeeze out rights. Squeeze out rights. Squeeze out rights. You know, this states that an acquirer who has attained a certain threshold of majority shareholding, can force the minority shareholders to sell their shares, can force the remaining minority shareholders to force their shares. Can force the remaining minority shareholders to sell their shares. These are called squeeze out rights. You know what? Minority shareholders have a tendency in that they are like a thorn in the flesh. Can you imagine? Warorwa. Unongoziva zvinoita vanateche. Iwo kana uchinge warora, you would say, look, this person is now mine, this person is now mine, should listen to me, we should discuss as two peoples. And then you know what happens with minority shareholders. They are always a thorn in the flesh. Now, companies also have
Sorry,
when you, yes?
I just wanted to check. Since it's a regulatory framework, I thought there is more certainty. Is there no thumb rule to the threshold that can be attained in terms of the majority shareholding?
Not necessarily. There's no thumb rule. Because this is an international exam, it changes from one jurisdiction to another. Like here in Zimbabwe, squeeze out starts at 90%. In the UK, at 95%. So we say a certain threshold. We need not to specify that. Well, so
right.
So can you imagine? Companies also have got what we call minority shareholders. Those guys who always keep troubling the peace between these guys, the companies which have acquired each other. Now, according to the squeeze out rights principle, you as an acquirer who has attained a majority threshold, you have a right to force, not to negotiate, otherwise it ceases to be squeezed, to force the remaining minority shareholders to sell their shares to you. Yes, so they are squeezed. Otherwise, this is all done in the interest of smooth running of the merged firm. And then we also have mandatory bid rule. Mandatory bid rule. You know, mandatory bid rule says, no, an acquirer with an acquirer having attained certain threshold. Let's say certain, because this is an international exam. It's not like Zimbabwe. We don't take Zimbabwean context. Let's say certain. An acquirer having attained a certain threshold of majority shareholding, you know, can buy the remaining minority shareholders, can buy the remaining minority shareholders, at the last highest agreed bid price. At the last highest agreed bid price. Last highest agreed bid price. Last highest agreed bid price. So, you know, last highest agreed bid price. So it's like this. You buy Atlantis and you are now at 90%, and the last price you bought a share for was $5. So in other words, NCI or minority shareholder is 10%. Now, according to a mandatory bid rule, even though the price is now $4, if you want to buy the remaining 10%, you don't buy them at $4. Even if the market price is now $4, you buy them at last highest agreed bid price. So you buy them at $5 if you want to buy them. So suppose the market price is now 4 and you say, look, I want to buy the remaining minority shareholders. The regulatory principles don't allow you to buy them at 4. Otherwise, you want to take advantage. So you buy them at the highest. When we concluded the merger, we concluded at 5. Should you want to force them, or should you want to buy their remaining interest, according to mandatory, you are mandated to buy them at 5. So what are all these meant for, you may ask? These are meant to protect, they are meant to protect the acquirer. They are also meant to protect the target, the mandatory bid rule. You get that? Like squeeze out rights are meant to protect the acquirer, and also meant to prevent a situation where NCIs are a thorn in your flesh. Those who don't control, let them squeeze them out. So ungazoti sei vari kuti saka vana tete ngavasqueeze out, sei vati kuti uvasqueeze out hunge waacquire a certain threshold. Haungati hauna kumbobhadhara mudzimai wako, hausati wambobhadhara 90%, wakuda kutoti vana tete let us squeeze them out. Sei vanamboda zvinoitwa naakabhadhara and akasvitsa a certain threshold, kwete kuti wangobhadhara tsvakirai kuno undoti ndini ndoda kuteererwa, ndini ndoda kuteerera. Hakuna squeeze out right dzakadaro. Okay, so you have that. And then continuing with our discussion, we are now at, this is like theoretical stuff, but at least let us escalate it to valuations. Valuations. We want to do a question, remember? Valuations. So you know what? There is value of the target. VT is value of target, which we refer to as VT, value of acquirer, we refer to as VA, and value of the merged firm, value of the merged firm, merged, by merged we mean combined firm, which we refer to as VM, can be determined using any of the following valuation basis. Any of the following valuation basis. We did business valuation when we did F9. So the same valuation basis can be used to find the value of the merged firm, value of the acquirer, value of what. So for example, please pay attention. We have got net asset basis, net asset basis, net asset basis. We call this NAV, net asset basis. You remember, you say equals total NRVs of assets, less total liabilities. total NRVs of assets less total liabilities. That's net asset value. And you know, for NRVs of assets, total NRVs of assets, this is excluding goodwill. Included when you are calculating NRVs of assets. And then we have earnings basis, PE ratio method. PE ratio method. PE ratio method. How do we value the business using PE ratio method? You simply say value in brackets in value slash P0 equals value, or P0 equals earnings times PE ratio. Earnings times PE ratio. That's PE ratio method. You know, earnings multiplied by PE ratio, you get value. That's the PE ratio method. You get that? So PE ratio method is also known as earnings multiple. PE ratio method is also known as earnings multiple method. It's also known as the earnings multiple method. That's PE ratio. Right? You know what? And when we are saying earnings means earnings after tax. Earnings equals earnings after tax. Earnings after tax, or EPS, share. If you are calculating value per share, you use EPS. If you are calculating value of the company, just use earnings after tax. If the question is requiring value per share, you use EPS, meaning earnings per share. So if you are given pre-tax earnings, suppose the examiner is given you pre-tax earnings, always know that the earnings we mean there, it's earnings after tax. We don't mean retained earnings, because you might be given earnings after tax, retained earnings brought forward, and retained earnings carried forward. We mean earnings after tax, meaning profit for the year. We don't mean retained earnings by earnings. All right? So these are valuations. Notice I am bringing to the four formulas that you already know. I'm just bringing them, that the formula that you already know. Another is number three, it's dividend yield. I mean earnings yield. Earnings yield. Equal. You say P0, meaning value, equals earnings over earnings yield. If you are using earnings yield method, the examiner will tell you the formula that they want. The examiner will tell you the formula that they want. They don't necessarily tell you. You can deduce from the information given that the formula required in this particular case is what. Now you can also have dividend basis. Dividend basis. Dividend basis. Now, for dividend basis, we have two approaches. There's the first approach which is fixed dividend. Fixed dividend. You simply say P0, value is P0 equals, you simply say dividend over required rate of return, RE, you know, where RE is the required rate of return on equity. Required rate of return on equity. We call it cost of equity, remember. It's the required rate of return on equity. Put simply, it is the cost of equity. Right? And then there is growing dividend. Growing dividend. Now, for growing dividend, it is better known as dividend growth model, DGM. It says P0 equals D0 bracket 1 plus G, 1 plus G, close bracket, over, open bracket, RE minus G. In this case, where D0 is the latest dividend, So this formula, it's an exam formula. You are given this formula anyway. This formula it will be given in the formula booklet. D0 is the latest dividend, and then G equals expected growth in dividends. Expected growth in dividends. And RE is the required rate of return on equity. R on equity. That's RE. It's simply required rate of return or cost of equity. Simple as that. Now, you know what? If you listen, if you have played the video on cost of capital, I'm sure you came across issues on how do we estimate growth rate when it is not given. If you have forgotten, please go over that. You know, G, how to estimate G. So we can estimate growth rate as follows. Estimating G. So here's how we can estimate G. You can say G equals B times R, or G equals latest dividend over earliest dividend to the power, open bracket, 1 over n, close bracket, minus 1. These are the two ways of estimating G, depending on the information given. Please, if you still have issues on this, revisit the video on cost of capital. Revisit the video on cost of capital for you to understand how G is calculated. We gave plenty of examples on that, and everyone has the video on that. So that one I'm not going to take much discussing that here again. Yes? Yes?
You gave the formula for growth, B times R. What is B? What is that?
Yes, that's where I'm saying it's there in the formula for cost of capital, but I can say it here, since you have asked, in the interest of convenience. B is the earnings retention ratio. B equals earnings retention ratio. That's your B, meaning proportion of earnings which are not distributed as dividends. And then R is the return on equity investments. R equals return on equity investments. Return on equity investments. Return on equity investments. What is that? Oh, no. Return on equity investments. That's your R. So you'll be given. You know what? Suppose you are told that the company is a dividend payout ratio of 40%. It means For every dollar in earnings, dividend is 40 cents. So what is the retention ratio? It will be 60%. And the return on equity investments or return on investments you'll be given. So that this is not an issue here. Right? For full information on this, please play the video on cost of capital. We discussed this at length with examples. Play the video on cost of capital. I've sent it. It's there in our WhatsApp group. Then we do have also, there are a lot of methods of valuing shares. We also have what is called earnings multiple. Earnings multiple method. So earnings multiple we have discussed, that's PE ratio. We also have what is called free cash flow method. Free cash flow method. Free cash flow method. When you are using free cash flows to value the firm, perhaps it starts by a free cash flow method of valuation. Cash flow method. I want my discussion to be 2 hours sharp. So I'm ending my discussion at 7:30. So I'm about to finish this. Then we do question. A free cash flow method of valuation. Now, when you are valuing the firm using free cash flows, perhaps what is required is for us to understand what is free cash flows. From the definition itself, free cash flow means cash which is free. Cash from operations that is left out after you have set aside all the cash you need to do whatever you want to do. That's free cash flow. It derives meaning from its term. It's free cash flow, meaning cash which is now free. But it doesn't refer to cash at bank. No. It refers cash flow from operations, which is remaining after the firm is provided for whatever it wants to buy and whatever it wants to purchase or to repay. Now, there are two types of free cash flows. When you are using free cash flow method, it depends on which type of free cash flow is being spoken of. Now, I shall come to the free cash flow method of valuation. But for now, let me discuss free cash flows. What does this mean? So there is what is called free cash flows to the firm. Free cash flows to the firm. There are two types of free cash flows. There's free cash flows to the firm, which is CFF. This is calculated like this. Here is how you calculate free cash flows to the firm. You say EBIT. Okay, let me perhaps have it like this. You say EBIT, XXX. Then you say tax on EBIT. You say less tax on EBIT. Tax on EBIT. Tax on EBIT. Notice you don't deduct interest. I have not deducted interest. I just said EBIT. Less tax on EBIT. Then you say add non-cash items. Non-cash items, e.g. depreciation. Non-cash items, e.g. depreciation. Why are we adding this? It's because we are looking for free cash flows. And then you say less working capital increase. Working capital increase. If there is working capital increase, remember, if working capital increase, it's a cash out. Add working capital decrease. Add working capital decrease. If there's a working capital decrease, it's a cash in. Add working capital decrease. And then less capital expenditure. cash you want to put aside for capital expenditure, you take it out here, less capital expenditure. And then you say, well, because you are calculating free cash flow to the firm, you end here. So this becomes free cash flow to the firm. That's how you calculate free cash flow to the firm. All right. I want you to see the distinction. So when you're calculating free cash flow to the firm, what are the points to note? Don't deduct interest. Don't deduct interest. That is the only key difference here. Another is don't deduct debt repayments. Don't deduct debt repayments. That's free cash flow to the firm. And there is also what is called free cash flow to equity. Free cash flow to equity. Another name for this, for free cash flow to equity, it's actually free cash, it's FCF, free cash flow to equity. It's free cash flow to equity or dividend capacity. That's another name for it. Some call it free cash flow to equity, others call it dividend capacity. Because you need to understand, if you are valuing the firm using free cash flows, which free cash flows are being referred to? Are they saying free cash flow to equity, or are they saying free cash flow to the firm? It's so important. So free cash flow to equity, it can be given as free cash flow to equity or dividend capacity. Here you say profit before tax. So it will be like profit after tax. Let's say profit after tax, profit after interest and tax, profit after interest and tax. Meaning you deduct interest, you also deduct tax. Then you say add back non-cash items. Add non-cash items such as depreciation. And then you say less working capital increase. If there's a working capital increase, you subtract it. If there's a working capital decrease, you add it. Working capital increase is in bracket. Working capital decrease, you add. Then you say less net debt, less capital expenditure. Cash you put aside for capital expenditure. And then less net debt. By net debt, we are saying debt issued less debt repayments. Debt issued less debt repayments. Debt issued less debt repayments. That's net debt. So you can see that this figure can be positive or can be negative, depending on whether debt issued is cash in, debt repayment is cash out. So what you get here is free cash flow to equity, which is dividend capacity. Free cash flow to equity, better known as dividend capacity. Get that? So you need to understand which free cash flow the examiner is referring to. If the examiner is saying free cash flow to equity, that's how you calculate it. If the examiner is saying free cash flow to the firm, that's how you calculate it. Now, this is how you calculate free cash flows. Notice, if you get free cash flows here ever, it does not mean this is the value of the firm. It amounts to, imagine a situation where you get dividend and then you say value of the firm is dividend. No. Value of the firm is the present value of dividends. So it's one thing to get free cash flows, it's another to get value. Value is the present value of those free cash flows. So important. So if you want to find value, valuing the firm using free cash flows. So what you do is, so you now say valuing the firm using free cash flows, valuing the firm using free cash flows to the firm. How do you value the firm using free cash flows to the firm? Steps involved. Steps involved. Steps involved. You simply say, step 1, forecast free cash flows to the firm, for each year. Forecast free cash flows to the firm for each year. So you use this template here to forecast free cash flows to the firm for each year. So it will be year 1, year 2, year 3, year 4, and you have got free cash flows to the firm for each year. Second, discount free cash flows to the firm using WACC. Discount, forecast free cash flows to the firm using WACC. Why using WACC ever, if you may ask? Because here we did not discount interest. We didn't deduct interest. It means interest is included in the WACC. So when you are now discounting them using WACC, that's where you are capturing interest. And then 3, subtract the value of debt from discounted cash flows. Subtract the market value of debt from discounted cash flows. To get value of the firm. You then have to take out value of debt to get value of the firm. So there you go. These are the steps involved when you are valuing the firm using free cash flows to the firm. Now, what if you are valuing the firm using free cash flows to equity? So this is valuing the firm using free cash flows to the firm, and then valuing the firm using free cash flows to equity. Using free cash flows to equity or dividend capacity. So what you do is the steps involved. When you are valuing the firm using free cash flows to the firm, to equity or dividend capacity. Notice, if you are calculating free cash flows to equity, you are saying cash flow which is left to equity. You deduct everything to do with debt, like interest, like net debt repayments, etc. And then you are left with cash flow available to equity. So first step, you forecast free cash flows. You forecast free cash flows to equity for each year. As discussed above. So you use this formula to forecast free cash flows to equity for each year. And then second step, you discount free cash flows to equity using cost of equity. Time you don't use WACC because it's free cash flows to the equity. So you discount free cash flows to equity using cost of equity. Then number 3, 3, EV of free cash flows to equity is the of free cash flows to equity is the value of the firm. Value of the firm. So what is the value of the firm? It is the PV of free cash flows to equity. It then becomes the value of the firm. In this second example, you don't deduct the value of debt because cash flows don't, for free cash flows to equity, they've taken out anything to do with debt. Now, valuing using free cash flow multiple method. Valuing using free cash flow multiple method. Using free cash flow multiple method. Now, notice when you use earnings multiple or earnings per share, you simply say value equals earnings times PE ratio. Now, when you are using free cash flow multiple method, you simply say value equals value or P0 equals free cash flow multiplied by free cash flow multiple. You simply say value equals free cash flow multiplied by free cash flow multiple equals free cash flow multiplied by free cash flow multiple. Simple as that. So anticipate a situation where you are given value and free cash flow multiple, but you don't have free cash flow. If you have got value and free cash flow multiple, it means you can get free cash flow. It's like this. Suppose value is 200 million and free cash flow multiple, which is free cash flow M, is 5 times. So what are the free cash flows? So you simply say 200 equals free cash flow times 5. So you may be required to find the free cash flow. You say value equals free cash flow times 5. In this case, free cash flow equals 200 over 5, which is 40. You get it? So that's how you may actually use it like this. There are instances the examiner can give you a value and multiple and asks you to calculate free cash flow. You may be told that the current share price is $10, which is a multiple of 5 on the current free cash flows. The current share price is $10, which is a multiple of 5 on the current free cash flows. So you are not given free cash flows. So what you do is multiply to find value, to say $5 times to get value, and solve this equation to find free cash flows. That's free cash flow multiple, right? Then synergies. They need to be valued. Synergies or additional value created. You know, we merge to create value. And this one I want you to pay attention. We merge to create value. That's the bottom line. Atidima major singa create a value. Atidima major kunge Peter na Thomas varorana. You know? Mukarorana muri Peter na Thomas. We're not confused. So share with you what the heck is that? What use is that? We want measures which create value. Peter and Susan. Those are measures which create value. So in final analysis, we want to see the value created from the measure. So if I hold two things here, like the calculator and the make set, so don't let it making noise. Suppose I hold two things here, the calculator and this piece of paper, and they become a merged firm like this. What is the value created from this merger? It's an easy task. We simply calculate value of this paper before the merger, value of the calculator before the merger, and then value of the merged firm. So if you want to see value created, we then say value of the merged firm minus the values of these individual firms before the merger. You get that? So it's simple like that. So the question now, in your exam, the examiner may simply say calculate the value created from the merger. It's easy. If you want to find the value created from the merger, it's simply value of the merged firm minus value of these two firms before the merger. That's simple. Value of the merged firm minus value of these two firms before they had merged. If value of the merged firm is greater than the combined value of these two firms before they merged, it means the merger created value. And this value then should be shared between shareholders of the target and shareholders of the acquirer based on the terms of the merger. You get that? So we do it like this. We say additional value created. Now value created equals, we say value of the merged firm, value of merged firm, which is VM less, then we open this and say VA plus VT. That's how you calculate additional value created. You simply say value of the merged firm minus the value these firms had before the merger. Simple as that. So you then say the value is then apportioned. The value is then apportioned between shareholders of the target and those of the acquirer using agreed term. I mean based on agreed terms. Based on agreed terms. Simple as that. After getting the value created, you then know who is to get what share of that value based on the terms which these parties agree. Now, for the merged firm, you are writing after me. If I say for the merged firm, and now for the merged firm, which is VM, you can calculate VM using PE ratio method. PE ratio method. Now, if you are calculating VM using PE method, you say P0 or VM value of the merged firm equals PE ratio of the merged firm times earnings of the merged firm. Merged firm. You now use earnings of the merged firm, which we can refer to as EM. And if earnings of the merged firm are not given, like EM can be given, earnings of the merged firm can be given, or you can say EM equals earnings of the target plus earnings of the acquirer plus synergy. Earnings of the target plus earnings of the acquirer plus synergy. That's how you calculate EM. Earnings of the target plus earnings of the acquirer plus synergy. And then you can use the free cash flow multiple method. Multiple method. Multiple method. Now we are dealing with the merged firm. You say VM merged firm equals free cash flow of the merged firm times free cash flow multiple of the merged firm. Free cash flow multiple of the merged firm. It is the same formula, but I'm just singling out to say when you are dealing with the merged firm, you use free cash flow multiple of the merged firm. Now, you may ask and say, how do we calculate cash flow multiple of the merged firm? Free cash flow multiple of merged firm. Free cash flow of the merged firm. Let's say free cash flow of merged firm equals free cash flow of the merged firm equals free cash flow to the firm or free cash flow to equity above, or you can say equals free cash flow of acquirer plus free cash flow of target plus synergy. This is how you calculate free cash flow of the merged firm. It can be calculated as free cash flow. You can calculate it.
Achatomboziva tiri kuenda kupa kwatabva kwatiri kuenda.
Yes,
achatomboziva.
I understand, because you are copying the formula. When you are calculating free cash flow of the merged firm, you can be told by the examiner that free cash flow of the merged firm is. So you calculate it using this free cash flow. They can say free cash flow to equity for the merged firm and free cash flow to the firm of the merged firm. So I am saying use this template. Or the examiner may not give you that, and then you calculate it like this. Don't worry, we will have examples to illustrate this. If the examiner doesn't give you that, you calculate it like this. You can simply say free cash flow of the merged firm equals, you can say free cash flow of the acquirer plus free cash flow of the target plus synergy. These are the two ways of calculating free cash flows of the merged firm. Warasika kamfa. Don't worry. I will retrieve you from your terrain and make sense of these things. So I don't want to add a lot of formula, because I mean, you know, as you say, I can add plenty of formula, but let us end here concerning valuations. So we are discussing quite a lot of issues on mergers and acquisitions. So we discussed advantages, disadvantages. We also discussed defensive tactics, target selection, meaning mitigating the risk that the acquisition will fail, which is called due diligence. We also discussed the defensive tactics, regulatory framework, valuations. So valuations is where, but there are very few, just a few, very few formulas, right? NB, NB being point to naught. NB right, this the cost of equity used. The cost of equity used. Cost of equity used to discount free cash flows to the firm or free cash flows to equity must first be adjusted for business, must first be adjusted for business or financing risks or financial risk associated with the merger. Associated with the merger. So don't worry about this free cash flow multiple thing. I will illustrate with an example, because without an example, clearly I agree with you, it doesn't make any sense. You can't remember it. But with an example, so I encourage everyone to hang in there until we finish. Last time we had an example, and I realized I had just to beg people to hang in there. Can you imagine you are the ones writing an exam and you are already exiting the lecture for dinner, for sadza? Can you imagine? Yet the exam is barely the first week of March on Friday, and I will be having one person at the end of the lecture. Under normal circumstances, once I do the lecture with you, I would say do questions. But if I then say hang in there and you let us do a question paper, it's now for your benefit. Otherwise, the lecture is already done. Then it's amazing how I'll be left with one person or none. And if you all exit, I won't be able to record. And next week, we will not be doing the same thing. It's amazing. And you want to be ACA members, after all. Can you imagine your behavior and your target? It's out of sync with each other. So we are saying the cost of equity used to discount free cash flows to equity or free cash flows to the firm must first be adjusted for business or financial risk associated with the merger. And do you still remember how to adjust for business and financial risk? We call this ungearing and re-gearing. You remember? Okay, so this involves the following steps, just in case you have forgotten. This involves the following steps. The following, right? This involves the following steps. Right, so this one is so important. It involves these steps, to ungear and re-gear. All right, step number 1. Calculate the asset beta for each firm. Calculate the asset beta. Asset beta for each firm. For each firm, if not given. If not given, calculate the asset beta for each firm. It's not given. Remember, asset beta is the other name. The other name for asset beta is ungeared beta. Calculate the asset beta for each firm if not given. How do you ungear? So you ungear as follows: ungearing slash asset beta. Now, asset beta means you are removing debt. So, Innocent, if you are told that the company is financed by equity, 100%, there's no need to ungear, teach on. Ungearing is only relevant if the company has got debt. So if the examiner say they want to acquire Atlan's, an all-equity firm, an all-equity financed firm, it means Atlan's, the beta you are given is asset beta. So how do you ungear? You say E over E plus D bracket 1 minus T times equity beta times equity beta. Let me repeat ever. If a company is financed by equity 100%, there is no need to ungear it, because ungearing means removing debt. So if a company is financed by equity, the beta you are given is equity, it's asset beta already. Step 2, calculate the average asset beta. Calculate the average asset using equity market capitalization, using market values of equity for each firm. Market values of equity for each firm. As follows. So you calculate average asset beta using the market values of equity for each firm as follows. Let's say we have got firm A and firm B, and then we have got a value of equity, market value of equity.
Sir,
yes.
Sorry to take you back. I'm hearing.
Yes.
If my memory serves me right, Pataita I'm gearing, isn't it, would take the value, a proxy firm.
Oh, well, we would take for proxy firm, but this time there's no proxy. We are ungearing each firm.
So, saka tikutora maningi value equity ne value debt for that particular
firm. Yes.
That's ungearing.
That's ungearing. This time it's not for like investment appraisal where we were ungearing the proxy. No, we are ungearing each firm. So E and D, it's market value for equity and debt for the firm in question. Are you answered?
I can follow now.
Okay,
I am
fine.
answered.
So market value of equity, let's say 200. Let's say 2,000. There, let's say 400. Then asset beta. Let's say this one is an asset beta of 1,2. This one is an asset beta of 0,9. The statement says calculate average asset beta using equity market values of equity for each firm. So you calculate all these market values, you won't be given. So my statement here is after you have calculated market values and everything, you then find the average asset beta as follows. So you now say average asset beta equals average asset beta. You now say 200 over 200, 2000 plus 400 times, this is like a denominator, times 1,2. So let me put large brackets here. Plus 400 over open bracket 2,000 plus 400 times 0,9. Calculating average asset beta, you then find it as, if I consult my calculator, I'm saying 2,000 divided by 400 times 1,2 equals plus open bracket 400 over 400 times 0.9 close bracket equals, so what I'm getting is 1.15. That's the average asset beta. So that's step number 2. Now, when do we do this? Remember, when you are discounting using free cash flows, we said you discount using WACC, or we said you discount using cost of equity. But the WACC and cost of equity to be calculated, here is this note NB, which says the cost of equity used to discount free cash flows to the firm, or free cash flows to equity, must first be adjusted for business or financial risk associated with the merger. This involves the following steps. So these are the steps you when you are calculating that that cost of equity or that WACC. Then number 3, re-gear the average asset beta. The average asset beta using post-acquisition capital structure. Using post-acquisition capital structure. What we mean is debt to equity ratio of the combined firm. Debt to equity ratio of the combined firm. Debt to equity ratio of the combined firm. You now say re-gearing. Re-gearing. It's actually re-gearing. Some call it equity beta. If it is given, there's no need to do this. Equity beta, you now say equals A over E times average asset beta times average asset beta, times average asset beta. That's how you calculate equity beta. Right? Then for use equity beta from step 3, calculate cost of equity. To calculate cost of equity, or to calculate WACC discount free cash flows to the firm. So cost of equity will be to discount free cash flows to the equity, or WACC if you are discounting free cash flows to the firm. Okay. So I don't have this part. I had to say it because it involves gearing and re-gearing. So just in case you might have forgotten how to ungear or to find asset beta, or how to re-gear, so I had to put it here as an NB. Now let us discuss financing measures and acquisitions. Financing financing measures and acquisitions. How do you finance mergers and acquisitions? It's like paying lobola. There are various ways you pay for lobola. So there are quite a lot of methods there. There's method 1, cash offer. Cash offer. That's method 1. Cash offer. When you're acquiring a company, you can pay cash. Now, Eva, you remember we did the groups. We said a subsidiary can be acquired by means of cash payment, deferred consideration, contingent consideration, share exchange. And these were methods of acquiring a subsidiary. These are the same methods we are talking about here. When you are saying methods of financing mergers and acquisitions. So cash offer, it's like this is when shareholders of the target are paid off in cash. Shareholders of the target paid off in cash. That's cash offer. Shareholders of the target are paid off in cash. You know? And then we do have what is called method 2, share exchange. Method 2, share exchange. Right. So write this. This is when shareholders of the target are issued with acquirers shares. This is when shareholders of the target are issued with acquirers shares. Acquirers shares in exchange of their current shareholding. Current shareholding. Exchange, when shareholders of the target are issued with acquirers shares in exchange of their current shareholding. So it's like this. So it will be like this. It will be like, let's say we have on this part, I know you know this part, let me not bother yourself. Share exchange, like you need to understand the exchange ratio and so forth. And then there's a mixed offer. Mixed or hybrid offer. Hybrid offer. Right? Mixed or hybrid offer. Right? This is a mixture of cash offer. This is a mixture. Cash offer. Exchange. Share exchange. This is a mixture of cash offer or share exchange. And then we also have what is called method 4. Method 4, debt offer. Like Kurora Nechquerit. No debt offer. You know that, right? This is when the shareholders of the target are issued debt securities of the acquirer, debt securities of the acquirer, exchange of their current shareholding. That's debt offer. There is also what is called method 4, mezzanine finance. Mezzanine finance. Mezzanine finance You know, mezzanine finance, it's like e.g. issuing debt securities which are convertible into shares. That's mezzanine finance. It contains, it's a debt offer with both equity elements and debt components, like a convertible debt. Right. So these are ways of financing the merger. So on these ways, write this NB, right? NB. With a cash offer, with share exchange, and debt offer, comma, the acquirer's shares and non-current liabilities increase is shares issued in exchange, or debt offered respectively. So you know what we mean by share exchange. Share exchange goes like this. If I want to acquire your company by share exchange, I am issuing my shares. I am saying give up your shares and come here and buy shares from this side. Give up your shares and buy shares from this side. So we are exchanging. If we say 1 for 5, I'm saying for every 5 you have there, I will give you 1 here. For every 5 you have there, I give you 1 here. So effectively speaking, I am issuing shares. Can you see that? I am actually issuing shares from this side. Another thing is, if it's a debt offer, I am saying give up your shareholding and take up liabilities here and be a lender here. Give up your shares, and instead of your shares, you are getting debt securities here. So you'll be lenders here. So effectively speaking, after the acquisition, my liabilities will increase, so to speak. Now, what are the methods to be considered when choosing a financing option? Right, these methods, factors to be considered. Factors considered when choosing a financing method. Factors to be considered when choosing a financing method. There are various factors you consider when you are choosing which method of financing to take. Quite a lot of factors. And these factors, don't think they have changed because they are now doing AFM. They are like factors to be considered when choosing sources of finance, which you discussed when you're doing FM. They are not like new, but unfortunately students they normally leave this section blank of the question as if you are being asked the AFM stuff, but you have forgotten FM stuff. What are the factors to be considered when choosing an ideal source of finance? Remember, you consider 1, cost of capital. Cost of capital. E.g., equity financing is expensive than all other sources. Equity financing more expensive than all other sources. Equity is expensive than other sources. You also consider attitude of shareholders. attitude of shareholders. Of target acquirer. You know, unogona uchida kuroora wobva wati uda kubhadhara cash, kunotoona vamwe vanenge vachitoida cash yacho iyoyo faster, kwozoita vamwe vanenge vachiti cash yeiko. You know, so attitude matters. Another is availability of cash. Consider availability of cash. If it's not there, availability of cash. Important. If cash is not there, you can't say I want to pay by cash. Do panozonzi tipei list. Tozopedzisa availability, because cash will not be available. Another is impact of debt financing. Impact of debt financing on existing covenants. Now, if you have got covenants with lenders that you should not borrow additional money, you need to understand, if you issue debt, what is the impact on existing covenants? Impact of debt financing. Debt financing on risk, on gearing, and firm's credit rating. Firm's credit rating. You know, if gearing is altered, it means your risk profile is altered, and this may impact on your credit rating. So before you choose debt offer, know this. Another number 6 is impact of share exchange. Impact of share exchange on ownership stake. Impact of share exchange on dilution of ownership and earnings. Dilution of ownership and earnings. Impact of share exchange on dilution of ownership and earnings. Well, quite a lot. So you can see there, I'm just taking from F9. I'm not like taking it from AFM. There's no, this is simple stuff that we have already covered in our studies elsewhere. Now, remember I said we are to end at 9:30 today. Let me see if I can put the call on hold. I wanted to see if it can do, if I can. Well, you have discussed quite a lot of things, but before I open a question paper, I need you and me to agree that the only new stuff was on free cash flows. Everything else wasn't new. The only new stuff was on free cash flows. Put that aside, everything is what you already know. You know how to value a business using dividend growth model, a price to earnings ratio method, a lot of other things, how to calculate WACC. But when you want to discount cash flows from a measure, you need to ungear and re-gear so that you reflect the business. Oh, it's now raining. So let me open the question, lest these rains may affect us and we will not be able to finish the question. It's raining like nobody's business. All right. Okay, so let me open the question and see. I'm sending the question via the chat feature. I'm sure most of you were waiting for this question. You were saying, say what we are discussing, we already know. We already know this stuff because I know some of you are revising. So you were saying, We already know the stuff, say. What we want is a question. For your sake, here I am. And you might be lucky, you may come across the very same question in assignments perhaps, but I don't think this one is in there. Okay. Right. Okay, so it's opening. September, December 2018. September, December 2018. Right. In the interest of time, I want to read question number 1. Around 7 years ago, Opal Company, that's question number 1. Around 7 years ago.
You're not sharing your screen.
Oh, I'm not sharing my screen. Oh, well, perhaps before I read this, how come the screen share exited? Oh, when I paused it. All right, sorry. Before I read the Opal Company and the other stuff, let me discuss with you what is called a reverse merger. You know, normal mergers are like this. A company which is listed on stock exchange would acquire a company which is not listed. That's normal merger. You know, normal merger is when a company with money acquire a company without money, or a small company. But kune mamwe mameja anenge ana Ben 10 arrangement. Have you ever heard of what is called Ben 10? Ben 10 arrangement is when a young man marries an older woman who is rich. That's a Ben 10 arrangement. You marry a famous and a rich woman. If you do that, we say there's a reverse merger, because it's not normal merger. It's a reverse takeover. So there is what is called reverse takeover. Can we just define it in the notes before I read? There's what is called reverse takeover. Reverse takeover. So what is reverse takeover? This occurs when an unlisted company. This occurs when an unlisted company acquires a listed company. This occurs when an unlisted company acquires a listed company. Right. An unlisted company acquires a listed company. And what are the benefits, if you may ask, of a reverse takeover? A situation where a company which is listed acquires a company which is unlisted. What are the benefits? If you acquire a famous company, you immediately become known. In other words, you immediately or automatically obtain a stock market listing. Right? This. The unlisted company automatically becomes. The unlisted company automatically assumes or automatically becomes listed. The unlisted company automatically becomes listed. The unlisted company automatically becomes listed. Full stop. Right? This. It is a cheaper way of obtaining stock market listing compared to initial public offering. It is a cheaper way of obtaining stock market listing compared to It is a cheaper way of obtaining stock market listing compared to initial public offering. It's a cheaper way of obtaining stock market listing compared to initial public offering. Like, zvakafanana nekuroora princess, mwana wamambo, or mwana wapresident. Immediately unobva wasanga kuzozivikanwa. Unlike dai wakagrowa your own name, it was going to be very difficult to be known. Asiwo zvine disadvantage yekuti unogona kunge usina experience yekuzomanager that listed firm. Haungangobve from nowhere and you marry a princess. You'll be shocked paunenge uchimuti wacha achikudza kuti nzara dzangu dzoda kutomboatendwa tu. Iwe unenge kutozvitora personal, yet because wakaita reverse takeover. Asi zvako. So the issue there is write this, however, comma, an unlisted firm may lack the requisite skills and competencies. An unlisted firm may lack the requisite skills and competencies to run a listed company. An unlisted firm may lack the requisite skills and competencies to manage. May lack the requisite skills and competencies to manage a listed company. Okay. So it was just a point to note there. Let me now proceed. Reading the question. Around 7 years ago, Opal Company, a private conglomerate company which involved in many different businesses, decided to obtain a listing on a recognized stock exchange by offering a small proportion of its equity shares to the public. Before the listing, the company was owned by 100 shareholders who were all closely linked to Opal and had their shareholding wealth invested in the company. However, soon after the listing, shareholders started selling their shares in Opal, and over the 2-year period after the listing, its ownership structure changed to one of many diverse individual and institutional shareholders. As a consequence of this change in ownership structure, Opal's board of directors commenced an aggressive period of business reorganization through a portfolio and organizational restructuring. This resulted in Opal changing from a conglomerate to a company focusing on just 2 business sectors: financial services and food manufacturing. The financial press reported that Opal had been forced to take this action because of the change in the type of its shareholders. The equity markets seemed to support this action, and Opal's share price has grown strongly during this period of restructuring after growing very slowly initially. Opal recently sold a subsidiary company, Bugatti, through a management buy-in, although it had an option to dispose Bugatti through a management buyout. In a statement, Opal's board of directors justified this by stating that Bugatti would be better off being controlled by an MBI team. Opal is now considering acquiring TAI, and details of the proposed acquisition are as follows. TAI is an unlisted company involved in a food manufacturing. Opal's board of directors is of the opinion that the range of products produced by TAI will fit very well with its own product portfolio, leading to cross-selling opportunities, new innovations, and larger market share. The board of directors thinks that there is possibility for economies of scale and of scope, such as shared logistics and storage facilities, giving cost savings opportunities. The board of directors believes will lead to significant synergy benefits and therefore it is of the opinion that Opawa should make a bid to acquire Thai company. Financial information to Opawa, Thai, and combined company. So it's like acquirer is Opawa, target is Thai, combined company is the merged firm. So this is the information you have. For Opawa has 2,000 million shares in issue, currently trading at $2.50. Thai has 263 million shares, and the current market value of its debt is 4 million. Its most profit before tax was 132, after deducting tax, depreciation, and non-cash expenses of 24 million. Thai makes an annual cash investment of 24.3 million in non-current assets and working capital. It is estimated that its cash flows will grow by 3 million annually in the foreseeable future. Thai's current cost of capital is 11%. So this information is for you to value Thai. Combined company. If Opawa acquires Thai, it is estimated that the combined company's revenue will be 7,351 million in the first year, and its pre-tax profit margin on sales is 15.4% for the foreseeable future. After the first year, sales revenue will grow by 5.02% every year for the next 3 years. It can be assumed that the combined company's annual depreciation will be equivalent to the investment required to maintain the company at its current operational level. However, in order to increase the sales revenue levels each year, the combined company would require an additional investment of 109 in the first year and 31 cents for every dollar increase in sales for each of the next 3 years. After the first 4 years, it is expected that the combined company's free cash flows. Now, they are saying combined company's free cash flows. So this is free cash flows to the company, meaning to the firm. It is expected that the combined company's free cash flows will grow by 2.4% annually for the foreseeable future. The combined company's cost of capital is estimated to be 10%. So notice this either. Combined company's cost of capital is estimated to be 10%. So you are given combined company's cost of capital, meaning there's no need to ungear, there's no need to re-gear, because you are already given combined company's cost of capital. If you were not given it, this figure, that's where you would calculate it by following that. But if you are given it, the cost of capital, there's no need for you to calculate average asset beta. Remember, that was necessary to calculate the cost of capital for the combined firm. So if the examiner has given you that cost of capital, don't follow through those steps like asset beta, average asset beta. That is only done if you are calculating cost of capital to use in discounting cash flows. But if it's given already, there's no need. All right. So the combined company's cost of capital is 10%. It is expected that the combined company's cost of equity level will be maintained at 4. The combined company's debt to equity level will be maintained at 40 to 60 in market value terms after the acquisition has taken place. Now, after the acquisition has taken place, both Opawa and Thai pays corporate tax on profits at an annual rate of 20%, and it is expected that this rate will not change if Opawa acquires Thai. It can be assumed that the corporate tax is payable in the same year the profits arise or profits are charged on. Possible acquisition price offers. Now, this is now financing. Opawa's board of directors is proposing that Thai's acquisition be made through one of the following payment methods. So these are the payment methods. A cash payment of $4.40, that's one. 2, a share for share exchange, where a number of Thais shares are exchanged for Opao's shares, such that 55% of the additional value created from the acquisition is allocated to Thais shareholders, and the remaining 44.5% is allocated to Opao. Or through a mixed offer of a cash payment of $2.09 per share and one Opao's share for each Thais share, it is estimated that Opao's company's share price will become $2.60 per share with such a mixed offer. All right? Similar acquisitions in the food manufacturing industry have normally attracted a minimum share premium of 15% to 40% required. Distinguish between a management buyout and management buy-in, and discuss reasons why Opao's board of directors might have sold Bugatti through management buy-in. Can you unmute and talk to me? What are the differences? What are the they are saying discuss the difference between management buyout and management buy-in. And in your opinion, why is it the board of Opao might have sold Bugatti through a management buy-in? Just unmute and talk to me. Anyone, you can unmute and talk to me. What are the differences between management buy-in and management buyout? We did this, you have it in the videos that I sent to you. With the rest of the class, we did it. We did this under sources of finance and stuff. Talk to me, guys. Is this true? Or you guys are already having your dinner while I'm talking to myself?
Hello, sir.
Yes, Chichon.
Let me try management buyout.
Yes.
It's a situation whereby the existing managers take over the business in terms of how best they can run it. For the benefit that these guys have already have got the current knowledge of the business and how to run it, so it becomes easier and smoother for them to go ahead and run the business.
Correct. What about management buy-in?
Then management buy-in is a situation whereby outside managers run the current business, but it's normally being supported by what are these guys who've got very large sums of cash. They need support because they don't have enough cash and they don't have the knowledge of the business. Hence, they might bring in fresh ideas from outside on how to run the business.
Okay, correct. So you are saying management buyout is a form of organizational reconstruction in which the firm is sold to its current team of managers. That's management buyout. A firm is sold to its current team of managers. And then we do have management buy-in. It's when a firm is sold to an external team of managers. And these managers normally don't have money to buy the company. So normally they get assistance from venture capitalists. That's what Teacher Ona wanted to say. They get normally assistance from the venture capitalists, or they might have enough to buy it. It's possible also. Now, the question is saying, why, in your opinion, do you think Opao decided to sell Bugatti through a management buy? Why is it management Opao decided to sell the company to external managers rather than to the team of internal managers? There are various reasons for that. Perhaps external managers had more money. They could buy it at a higher price than internal managers. That is a financial case for that. Or they decided to sell the company to external managers because external managers have fresh ideas and strategies which Opao views they are better placed to unlock value for the firm. You get that? So it's just 4 marks to define what buyout and buy-in is, and then tell the reasons, possible reasons why Opao might have decided to use it to sell the company to external managers rather than to internal managers. Right? So you have that. And then explain what portfolio and organizational reconstruction involve and discuss possible reasons. Okay. Concerning this is called unbundling or organizational reconstruction. It's the subject matter of next week's lecture. But next week, we want to wrap up everything and finish. So what it means is next week, we are meeting on Tuesday. We are also meeting on Wednesday. So on Tuesday, we are meeting on Tuesday for organizational reconstruction. We are also meeting on Wednesday for mergers and acquisitions. So concerning second part of the question, which is saying explain what portfolio reconstruction is and what organizational restructuring is, we shall discuss these parts next week. Let me not bother myself for now. Let us jump to the other parts which we have discussed today. This is what we want. What we have discussed today is part C and part D. Notice, we shall come to part C later, but can we read part D? Part D is saying, following MBI and following the MBI, the board of Bugatti announced that its intention was to list the company on a recognized stock exchange within 7 years. The board is discussing whether to obtain a listing through initial public offering or through a reverse takeover, but does not currently have strong preferences for either option. Distinguish between an IPO and a reverse takeover, and discuss whether an IPO or reverse takeover would be appropriate method for Bugatti to obtain a listing. Now, when you want to list your company on the stock exchange, there are two ways of doing it. You can actually list your company through an IPO, initial public offering. This is the normal methodology, where you apply for stock market listing and you are told about the conditions required for you to get the stock market listing. And a company which is listing for the first time, which is initial public offering on the stock market, it goes through the primary market section of the exchange, the primary section. And on that section, there are a lot of financial intermediaries that you have to engage so that your listing will be successful. These include parties like underwriters, issuing houses, transfer secretaries, like underwriters, issuing houses, transfer secretaries, public accountants, or reporting accountants. All these, they charge fees to assist you in obtaining stock market listing. And so this makes initial public offering a very expensive option of obtaining a stock market listing. In mitigation, firms opt for what is called reverse takeover, which is a cheaper option. Reverse takeover arises when a firm which is unlisted, like Bugatti, buys a listed firm. It buys a listed firm. So because Bugatti will now be the controlling shareholder of a listed firm, it would imply automatically that Bugatti obtains the stock market listing. So it's a quick and easy, it's a quick and cheaper mechanism of obtaining stock market listing. And then, it's that advantageous. Bugatti being unlisted, they are now shareholders of a listed firm. They might lack requisite skills and competencies to run that listed firm. So, on the financial case of it, Bugatti board may opt for reverse takeover, but provided it works on capabilities or skills and competencies. But if finances permit, they can still go for initial public offering because they want to get listed in 7 years, meaning there's still plenty of time. So there's no urgency in getting listed in this case. So you just, all sides, provided they are reasonably concluded, we accept that in marking. Now, can you imagine already theory is important in your AFM exam. Don't ignore theory, because like in this case, theory alone, 8 plus 9, you are now 17 marks theory. Now prepare a board, prepare a report to OPAL. Oh, you know what? I'm getting a report from I'm getting a report from guys in the dining. That's where my Zoll is. That they've received a message. Let me check what message is it. You know, Zoll at times I want to work with that because they might be okay. Today is 10. Also, this one is not message for today. So it was a message for yesterday for the scheduled maintenance. So it's not going to affect us. Just wanted to check, otherwise our lesson will be cut short. Now, part C says, notice marks allocated for part C. 22 plus 7 are 22 plus 11. That's 22 plus 11, that's 33 marks on part C alone. It says prepare a report for the directors of the board of OPAL, which now, because your exam is computer based, I want to open a computer based platform to answer this part. I want to open a computer based platform to answer this part, so that I will teach you how to answer it on a CBE platform at the same time we are doing this question. All right. Okay. Now I just want to open this paper and answer it on a CBE practice platform. And concerning this platform, I trust everyone is doing assignments. Now, this is CBE practice platform, AFM past papers, December 2018. December 2018 AFM. So December 2018. So here you are, and it's resume. You know, I once discussed it with your colleagues, so no wonder why it's saying resume. Then next. Now, this is the company. We have already done all the question with the reading of the exhibits. Now, if it is on a computer-based platform, the question will be like this. So these are the case requirements. These are requirements, and we are on C. Estimates of the value of OPAL and TAI before the acquisition and of the combined company after the acquisition. Estimates of the percentage gain in value of each of OPAL company's share and TAI company's share under each of the financing option. Evaluates the likely reaction of OPAL and TAI shareholders to the acquisition offers. Right. So there you go. Now my issue here is, after reading a question like this, you then come to your response options. You can answer it on a spreadsheet, or you can answer it on a word processor. Now this is a report, so you answer it on a word processor. You still remember the report. The report is written nicely to the directors of OPAL. You can say report to the directors of OPAL. Report to the directors of OPAL. Right? So you say, you can put it like this if you want. or you can as well put it like where it was. Then you say this now subject. A report should have subject. Proposed acquisition of tie. Proposed acquisition of tie. That's the subject of our report. You can underline it and then enter. You remove underline and bold and say this report evaluates now the issues of what the report entails, you get them from the question. This report provides estimates of the value of equity value of all power and tie, percentage gain under each etc. So you say this report provides estimates of the equity. If you want this to come to the front, you just click here, it comes to the front. Estimates of the equity values of opal and tie before the acquisition, and the equity value of the combined company and the equity value of the combined company after acquisition. The second section of the report provides estimates of percentage gains to shareholders of tie and those of opal under each financing option. The report concludes with a now you check what the question wants. Evaluate the likely reaction of opal and tie's shareholders to each acquisition offers. So the report concludes with an evaluation the likely reaction of tie and opal's shareholders under each financing option. So there you go. Now if you want to know where tables are, bottom left here, you click bottom left and then tables are, this will pop up. Tables are under the heading formula sheet. You know there's workspace help, formula sheet, exam instructions. So tables are under formula sheets like this. So you first have your formula, and then under the formula you now have your tables, because I had some students saying I couldn't find the tables. So that's where tables are. Right now, so that's the of the report. It's just from the question itself. Now equity value So now we have equity values. Equity values. Equity value. That's one. You say one. One. Equity values. Equity values of opal, Tai, and combined company. So this, because it's a subheading, it's advisable to underline it, because it's a report. You write it nicely, or you can even bold it, right? And then you say, you remove your underlining and your bold. You say computations in appendix 1, computations in appendix 1, computations in appendix 1. Appendix 1 provides the following estimates of equity values. Estimates of equity values. So you now have, you can have it as a table like this. You know, here is a table. You can put it a table and say, you can put it nicely to say company equity value. Equity allowed. Equity value. So you say opal, Tai, or you can just type them without a table. It's too fine. Combined company. All right, so there you go. And then here, equity values, your equity values are in millions of dollars. Equity value in millions of dollars. So you say the computations in appendix 1. So you come to your spreadsheet, and then you say question 1, you reference it nicely, and then you say appendix 1 computation summary. Appendix 1 computation summary for opal. So the Eva, I understand, is Eva still there? Yes. I understand you now know that, as you say, I don't want a situation where you put 7 workings. I need 1 working on everything. 1 working is enough. Don't do 10, 20 workings. No, 1 working. Or if you are to exceed a maximum of 4 workings. So how then do you make sure that you minimize your working? You don't say working 1, working 2. You simply say computation summary. And this computation summary is about, you know, they are saying value of each company, that is on A. On 2, they are saying percentage gain. Percentage gain in value, meaning additional value created. That's a gain. Additional value created. So as a general rule, all computations on mergers and acquisitions are meant to find the value of the acquirer, value of the target, and the value of the combined firm, and then additional value created. So it will be like this. Oh, look, I'm now using this Excel. I'm now using, I'm opening the wrong question. I need to open this one. So you now say you can bold it. Oh, well, it's already in bold. So you say value of opal, value of opal. Easy stuff. You just come to the relevant exhibit, which is like proposed acquisition of Tai. Let us see, do we have, yes. This is where you get everything. So opal is 2,000 million shares currently trading at $2.50. So value of opal. So you can what you can clean your, this can be, you can drag this like this. Notice. So I have my word here. I have my spreadsheet here, and I have my exhibit. So if I want spreadsheet to come to the front, I go to the top gray area, click it. It's on the front. So value of opal, I then come here and say, this is my VT, remember. That's value of target or of acquirer. Opal is acquiring. So it is equals times $2.50. 2,000 times $2.50. That's value of opal. So I just say equals 2123 times 2,5. I already have the value. Then value of tie. Now notice, if I want this to come to the front, I put my cursor at the top, click it, it comes to the front. Then it says tie has 263 million shares in issue, and the current value of debt is 400. The most recent profitable profit before interest and tax is 132, after deducting tax allowable depreciation and non-cash expenses of 27.4. Thai companies makes annual cash investment of 24.3 million in non-current assets and working capital. It's estimated that its cash flows will grow by 3% in the foreseeable future. So clearly, this is free cash flows. So value of Thai is to be determined based on free cash flow. So you can say, you can bold it, value of Thai, and then you say current free cash flows. Current appendix, current free cash flows to the firm. Right. We want to find current free cash flows to the firm. You say profit before interest and tax. Profit before interest and tax. Profit before interest and tax for Thai, it's 132 million. So I come here and put 132 million. Profit before interest and tax, 132 million. Sorry, I click here. 132 million. And 132 million. I don't know who has put it, percentage. 132 million. And then I say add back depreciation. Add back depreciation. Depreciation is non-cash expenses of 27.4. So I add back 27.4. Come here. Add 27.4. 27.4. And then I'm also told Thai makes annual cash investment in non-current assets and working capital, 24.3. So that's capex, capital expenditure and working capital, less. Oh, sorry, the system is taking long to respond. Less capital expenditure, capex and working capital. Less capital expenditure and working capital, 24.3. So you say minus 24.3, and then you add the 3 like this. So you can, by adding, you can simply say equals sum. You can type it like this, equals sum, highlight like this, close. You get it, equals sum. Right, 24.3, good. So that's 132, 27.4 and 24.3. So you get oh, there's an element of text. Sorry, I omitted text. Now in this Excel, you don't insert. If you have omitted something, you cut You highlight like this and cut. You have omitted a line, so you say paste. Notice I've omitted a line. This is how you do it. And then you say tax on EBIT. Tax EBIT. Then you have to check what the tax rate is. If they're given us the tax rate, where is it? Is it on combined company? We need to check where the tax rate is. Right, tax is 20%. Both Opawa and Tai pay tax at 20%, so we have omitted tax. So you say tax equals minus, you say here, minus 0.2. Oh, sorry, the internet is not this fast. Minus 0.2 times this. Yes. Notice you say equals first, minus 0.2 times this. Is put an equal sign. Then sum, current free cash flows, you say equals sum. Don't necessarily do it one by one, you won't finish. Make use of the sum function. So it's coming out as 108.7. Now, this is the current free cash flows. Then you say value equals, you say free cash flow, now bracket, they are saying it is expected to grow by what? Free cash flows are expected to grow by 3% and cost of capital is 11%. So you now say free value equals, growth rate is constant, 3%, 1 plus 0.03 over 11%, or 0.11 minus 0.03, because it's like dividend growth model. But what we are now using is free cash flow. So free cash flow now, this is the current free cash flows. So the answer that you have gotten on top here is the current free cash flows to the firm, which we are referring to as FCFF 0. FCFF 0. So that's your FCFF here. FCFF 0. So you can simply come here and say equals 108 times 1.03 over denominator gives 0.08. Enter. That's, you put, if the number you can't see it, you custom it to 2 decimal places. So it's 1.4. And then you say, remember, after discounting free cash flows to the firm, for you to get value of the firm, we said you then say less value of debt, less value of debt.
Sir,
Yes. Pardon.
Value yapanda kuyinzuzi.
All right, it's okay. I'm coming there shortly. Right. All right, it's okay. I'm coming there back shortly. Now, less value of debt. Here is the value of debt, 400. So you come here and say less value of debt minus 400. Oh, sorry. You know, this thing requires a very, very robust network. Right, minus 400. And then you then say value of tie. Value. Oh, that's now equity value of tie. Equity value of tie, which is value of the target, that's VT. So it becomes 1000. We can say equals this plus this, which is 1000, 2 decimal places. Now, Eva, you are saying you need an understanding of value. So I need to come back to this. Notice, I just want to tell you what you already know. If the examiner has said dividend for the current year is $22 and it is expected to grow at 3% in the foreseeable future, and the cost of capital is 11%, you would simply say value equals D0 bracket 1 plus G over R minus G. Are you in agreement with me on that part? Sorry, can you unmute Eva and talk to me?
You had said but so I was waiting for
I'm saying I need you to understand.
That's the formula.
I need you to understand me step by step. If the examiner had said dividend is $22, expected to grow at 3% in the foreseeable future, and cost of capital is 11, you do simply say value equals dividend bracket 1 plus G over R minus G. On that part, will you agree with me, right?
Yes.
Now, this is in this case, the information. Hey, it's raining. The information which is given is not about dividends, but rather it's about free cash flows. But again, the free cash flows are 3% in the foreseeable future. So there are no number of years given. So you can't say year 1, year 2, year 3. If they say to perpetuity, that's what they mean by foreseeable future. So all you simply do is you use the same formula for dividends, but just put free cash flow.
Okay.
And now notice, because these are free cash flows to the firm, if you want to find value, remember to deduct value of debt, as we have put it in the notes. We said when you have used the free cash flows to the firm here, when you are calculating value using free cash flows to the firm, remember to take out value of debt here. Subtract value of debt from discounted cash flows to get free cash flows to get value of the firm. So that's what we have just done. Right?
Yes, I can follow that.
Okay, yeah, it's fine. It's fine. Don't worry. Feel free to ask even when you are doing questions. As soon as you are at a point where you don't understand, just take a screenshot and say what do they mean by this? You know, you might be struggling with a very, very simple concept, which I can just explain in a sentence and you move on. That is what you must be doing from now until you write. Feel free to ask questions. Now we have value of tie, value of power, now value of combined.
Sorry, sir.
Yes.
Is this type of shorthand acceptable in the exam, like the free cash flow for firm, the FCFFF, or we have to write it in full?
To say this particular notation of FCFF is because we have already done it for. I'm taking advantage that you already know it from the notes. You write it in full.
Or you have to write it in full.
Yeah, but you write it in full only once and put it in brackets so that in subsequent citations you are no longer writing it in full.
Okay.
Yes. So what you will be doing is, I need one working in an exam. I don't need you to say working one, working two. Imagine if you were saying that by now you would be at what working? It is just one appendix, which is just written computation summary, and then you just do it skipping a line if you now on another working. So like value of combined firm. Of combined firm using free cash flows to the firm. Now, you may say, why are you saying free cash flows to the firm? Where is it written? Let me show you combined company. I open combined company like this. If they are saying if Opao acquires TAI it is expected that the combined company's sales will be 7,351 million in the first year, and its annual pre-tax profit margin on sales will be 15.4 for the foreseeable future. Now, already information that you are given of EBIT, this information is pointing to free cash flows. The examiner does not say calculate value using free cash flow. The examiner will never do that. You need to deduce it from the information you are given that the ideal method to use there is free cash flow. After the first year, revenue will grow by for the next 3 years. It can be assumed that the combined company's annual depreciation will be equivalent to the investment required to maintain the companies at current operational levels. However, in order to increase sales, the combined company will require additional investment. That's capital expenditure. Then after the first 4 years, it is expected that the combined company's free cash flows, notice the examiner has now said it, free cash flows. So obviously, you are being asked here to calculate value of the combined firm using free cash flows. Remember, you can highlight in an exam. You choose your highlight here. So you can as well highlight let me see if this is highlighting. Okay, yes, as you can see, you can highlight in an exam so that, or you can strike through in an exam. Suppose you want to highlight this. The combined company will require additional investment of 31 cents per every dollar. If this you can strike this information through like this to take note of it. If you want it to be prominent, you can still do that. And don't think by closing the exhibit you lose your highlight. I can close my exhibit like this and come back to the exhibit again. Notice what I have highlighted is still there. So don't think that because you have highlighted, so you can't close the exhibit. And don't be tempted to save. This thing here, which is appearing like a save button, it's not a save button. It's a reset button. If you click it by mistake, it removes every working that you have done. So don't think of saving. The working is saved automatically using cloud storage, which ACCA uses. It is saved every second. So there's no need of you bothering yourself. So because you want to find the free cash flows and you are given planning horizons of, they are saying after the first 4 years. So you are given 4 years as the planning horizon for our company's free cash flows. So you put your windows like this so that you'll be seeing everything. So if you want this to come to the top, again I said, you do it like this. So you say, yeah. Oh, sorry. It's taking long to respond when I change the exhibits. When I change it's an internet issue, of course. Yeah. 1, 2, 3, 4. It's 4 years and then 5 years plus. Year 5 plus, meaning year 5 and beyond. So it's 4 years and then year 5 and beyond. So you are given a revenue. You are told that revenue. Remember, in our notes we say the free cash flow we start with EBIT. But now, if the examiner has said EBIT is 15.4% of revenue, so what you need to do first is to find the revenue. Definitely, you need to find revenue first. So revenue in year 1, they are saying it's 73.51. It will grow by 5.02%. So you just say revenue, and don't work it separately, please. Remember, revenue is 7,351, and then you just say do this in brackets. Revenue, open brackets, 7,351 in how heavy the rains are this side. In year 1, inflated. Year 2 to 4. You shorten it like this. I don't want a situation where you have a separate working for inflating revenue. We don't give you marks for that. 7351, 7351, and then you are inflating this by 5.02%, so it's like this times 1.0502. That's 5.02%. You can drag this. You know, dragging is as well required. So you have this for the first 4 years. So there you go. So revenue is not required when calculating free cash flows. We just put it there for the purpose of calculating EBIT. That was the only reason we put revenue there. So you close it like this, and they say EBIT. EBIT is what we need. EBIT. It's 15.4% of revenue. 15.4% of revenue. So you're saying equals 0.154 times the revenue there. So you have your EBIT. All right. All right. Then you say less tax on EBIT. Less tax on EBIT. So in the notes, when we say the forecast free cash flows, that's what we meant. You can see we are forecasting free cash flows. So tax on EBIT is at 20%. So you say equals minus 0.2 times this. So that tax on EBIT, 20%. It's a matter of dragging. And then you then say capital expenditure. Capital expenditure. I want people who understand English. English. Let me read notes on capital expenditure. They are saying, however, in order to increase sales, the combined company will require additional investment of 109 in year one, in the first year, and 31 cents for every dollar increase in sales in the next 3 years. So capital expenditure, according to that English, it's like this. Capital expenditure, you say minus, okay, taking long to respond here. Right, it's now responding. It's minus 109 in year one. Now in year two, it's 31 cents per every dollar. So you simply say equals 0.31 times, open bracket, every dollar increase in sales, which is this minus this. This is how sales are increasing. So you say enter, and you drag it like this to the final year. So you can now indicate everything to put to proper commas. Commas, you come here and put to 2 decimal places like this, nicely, as you can see. Now, having done this, you may say on this one, why is it you didn't say add back depreciation? I didn't say add back depreciation because there is this note here. Let me highlight it. What does this note mean? It says it can be assumed that the combined company's annual depreciation will be equivalent to the investment required to maintain current operational levels. When they say depreciation is equivalent to investment required to maintain current operational levels, they are simply saying depreciation is equivalent to asset replacement. So depreciation is now being treated as a cash flow by that. So there's no need for you to add back depreciation whenever that assumption is there. So by this, you bring your spreadsheet to the front. You now understand how to go about it. Then you say equals sum. These are free cash flows now. You start from EBIT. You don't start from sales, please. You just start from EBIT. You drag it nicely. You can now always your comma is here to put them in proper. These are now free cash flows. Free cash flows to the firm. When you are at this level, just shorten. The examiner knows this stuff, guys. Don't waste time writing in full free cash flow. You may do that in the report, but on this one, now they are now saying after 4 years of operation, notice there's a statement here which is saying at the end of 4 years, free cash flows are expected to grow by 2.4%. On this one, pay attention again, guys. After 4 years, free cash flows are expected to grow by 4%. Now, Eva, notice, in the foreseeable future, in the foreseeable future, whenever they say growth is now constant, it means this formula which says 1 plus G over R minus G, that formula now becomes to the 4. This formula here, in year 5, it will be 922,82 times bracket 1 plus G. Its growth rate is now what? 2.4%. So it's because the growth rate is now constant ever. Whenever growth rate is constant, that formula works. You remember we did this when we are doing FM. If you have forgotten that concept, still you are getting it here. Don't go back to read FM again. So when growth rate becomes constant, the formula for dividend growth model is used. So this time it's not dividend, it's free cash flows. So you then say 1 plus G, you put your cursor here, 1 plus 0.024 over, you can, in the interest of, you can widen the gap and then put over by underlining over R minus G. Your R is 0.10 minus 0.024. But notice, because this formula is used in year 5, if we had used it in year 0, I don't know if I may speak in Shona on this one. Because this formula is used in year 5, it gives you value in year 4. If you use it in year 1, it gives you value in year 0. So the value you get here is called terminal value. So you say equals this times 1.024 over open bracket 0.1 minus 0.024 close bracket, enter. This figure, notice, don't be scared if you see a figure like this. Just come to comma here and pick 2 decimal places. It arranges itself. This is called terminal free cash flow. Terminal free cash flow to the firm. It's like cash flow beyond the planning horizon. After having terminal free cash flows to the firm, you say net free cash flows to the firm. It's like we are saying net cash flows, free cash flows to the firm. We are now saying equals sum. We are taking the same figures here, heading up to here, enter, and then you drag to include. We now want to include the terminal value like this. In most cases, you find it worked separately. I don't want you to work it separately. Otherwise, you spend a lot of unnecessary time doing unnecessary things. You work it like what I am doing here. I know some of you will listen, some don't even listen. I don't know why. Because something is presented in the marking scheme, It does not mean that is a way of answering it always. Otherwise, you will not finish. You will not finish, believe me. You do it this way. Terminal value, just put the last free cash flow, bring it in year 4, so that you discount it at cost of capital. Present value interest factor at 10%. Now, if this cost of capital was not given, you would then have to do, now you can use tables. You come here and select tables. I showed you where tables are. But as for me, I always like doing it this way. I say 1, 1 equals 1, 1 to the power minus year, because I already have a year here. So to the power minus year like this, and then I drag my formula. I don't bother myself whether the decimals are coming out right or not. That's not my baby. My baby is here, PV. Notice I have saved a lot of time of copying the formula from tables. PV equals free cash flow multiplied by the discounting factor. Enter. And now I drag like this. Now the PV line is the one which I need. So it's the one which I then address the comma issues. Though you can still address your discounting factors, it's still fine. It's still fine to 3 decimal places. Oh, well, let us put to 2 decimal places. So there you go. So
Can you repeat how you calculate the discounting factors? I think it's quicker rather than referring to the table.
It because it's 10%, it's just, remember, the formula is 1 plus r to the power minus n. So if it is 10%, it's in year 1, you just say equals 1, 1 to the power. To the power, you say shift 6. That's to the power minus. And then you scroll and pick year n, which is the year there, and press enter. And then you just drag, you get the answer. Then sum of PVs, now sum of PVs, you say equals sum. Always make use of equals sum feature. There's no auto sum here. There's no auto sum. So for you don't do it individually to say this plus this plus. It will be time up whilst you are in this. So this is the sum. Now notice what we said when you are calculating value of the firm. After getting present value, remember to deduct value of debt. Remember to deduct value of debt to get value of the firm. So value of the combined firm in this case, it's not 11,198. Remember to take out value of debt. How then do you take out value of debt? You come to the combined firm. They are saying combined company's debt to equity ratio is 40:60, meaning value of debt is 40%, value of equity is 60%. So you can simply say less value of debt. Now, another way is just to say equity value 60%, but I'm doing it step by step. Less value of debt, which is 40%. So it's 40% of this. You say equals minus 0.4 times this. That's value of debt. And then the answer you get becomes equity value. Equity value. So equity value equals, you are now saying this plus, I'm saying plus because it's a minus. If you want to subtract a negative number, you say plus. If you put it as negative and you end up to say minus, instead it adds, it doesn't subtract. So this is equity value of the combined firm. Now, if you want to see if this firm has increased, yes, this firm created value. The major, yes, it created. Now, you were innocent. Are you not seeing that my working is very neat? Are you not seeing it? Can you just look at it? Very neat and precise. How on earth will examiner mark me wrong when I'm doing this? Even if it's time up whilst I haven't completed, like say question number 3, I was left with 15 mark things to complete. Examiners already have made up their mind about me. Examiners need it not to mark your entire paper to make up their mind about you. Look how precise and presentable the computations are. So can an examiner then say this person doesn't know? Their mind is already made up on question number 1 without even doing anything. Imagine a situation where you added sales, you added everything, and you calculated capital allowance. You messed the things up under the circumstances. Actually, if you mess up on free cash flows, there is really no realistic chance of you passing AFM exam, because the free cash flows are the cornerstones of cash-based methods of valuing a firm, which as examiners, we really feel a student should know. Right, and then now additional equity value created. Oh, so you now have the figures. You can now come to, you can now come to. So notice, Opower is 5,000. Value of Opower was 5,000. You can put them in bold for them to be standalone. Value of Opower was 5,000. Value of TAI was 999.51. And so you now come to the word processor. Value of Opower was 5,000. Value of TAI was 999.51. And value of, value of TAI was 999.51. And value of Opower, or combined value came out to be 6719.22. 6719.22. 6719.22. In the report, you don't put any working. We don't want any working in the report. We don't even want it. We don't want workings in the report, guys. All right. So your report, part 1 of the report is answered. What was part 2 of the report saying? It was saying estimate percentage gain in each. You only remember you have one report. You can have appendix 2, but still it will be ideal just to continue with your workings on one appendices. All right. So you come to your word processor. You come to your word processor like this and say you can say you come it like, right. You scroll down arrow to exit the table and you say to gain percentage gain to, it's percentage gain to shareholders of Opower and TAI under each financing option. Right. So you can say from appendix 2, or let me still say from appendix 1, because I don't want you to put a lot of things. I want you to be used to one appendix for everything. From appendix 1, from appendix 1, the percentage gains, percentage gain to shareholders of Opower and tie under each financing method are as follows. Financing method are as follows. The percentage gain to shareholders of power and tie under each financing option are as follows. So there you go. So how do you present it? You can present it and say, again, for in the interest of speed, you can just put table like this. It will be like this, the table. You say financing option, then you say gain to OPAL, as a percentage, and here gain to tie, again as a percentage. It's important because, you know, if you want to like type it, I'm sure clarity also in presenting. There's a question where typing is wholly required, like evaluate the part C of it. This is like do your workings and estimate the figures and come here. Now there are three workings. There is cash offer. Financing method, it's cash offer. That's number one. Number two, it's share exchange. Number three, Number three, it's mixed, meaning cash offer and share exchange. Cash offer and share exchange. Number three there. Cash offer and share exchange. Now, you are done already on part 2. That's where 12 marks are. All that is required is to come to your spreadsheet. Right. And you need to go to the relevant exhibit. The relevant exhibit, you know, you can close exhibits. It's possible benefits here. You know, if you open exhibits, it closes the one you have recently opened. So what you do is you drag it to put it on the side, so that you need to see the gray button on each exhibit, so that if you click it, it comes to the top like this. So all the way the current exhibits should be there. So you now say additional value created. Additional value created. Now, how do we calculate additional value created from the measure? Remember, we said we calculate it as like equals value of the merged firm, which is the combined value, minus value of acquirer plus value of target, meaning the new value of the combined firm, which is, remember, value of the merged firm is this one combined. So you can simply say equals. You now have figures here. This minus open bracket. Don't say the examiner will the examiner see that, say yes. No wonder why it is called Excel. Minus this plus you put value of acquirer plus value of target in brackets like this. So this is additional value created. You make, don't be surprised when it is coming up like this. It's an issue of comma. Just to come to your comma and put to 2 decimal places. So it's 720. It's actually 720 or 719,7. Now, how then do you proceed? This is additional value created. It's 719,7. Now let us go to cash offer and see how it works like. They are now saying cash offer is $44.40 to each Thais share. Now, you simply do this. You say current Thais share price. Current Thais share price. Current Thais share price. You know, value of Thai is 999,51 divided by Thai is how many shares? Divided by 263 million. Thai's shares are currently 263 million. So divided by 263 million shares. Oh, well, divided by 263 million shares. So what do you get? You know, you can extend this. So I simply say equals 999.51 over 263. This is current Thais value per share. It's actually $3.80. And now cash offered. Actually, I was supposed to say cash offer as a subheading. Let me cut. Remember, you can't insert on this Excel. You cut. If you feel like you have left something, cut, paste like this. I was supposed to write cash offer here. Cash offer. So that the examiner knows what I'm writing about here is cash offer. So I then say, right? So cash offered. Cash offered. So current value is 380. Cash offered is $4.40. So what is the gain? Gain. Are you not seeing? This is how you calculate gain. Gain equals $4.40 minus $3.80. So you gain what? You gain 60 cents. This is the gain. So percentage gain to Thai. Percentage gain to Thai. Now percentage you can write it in as a sign. There's no problem. Now if your current value is $3 and you gain 60 cents, so percentage gain to Thai becomes 60 cents over 380. Remember? So what do you get? It equals 60 cents over 380 because your current price is 380 and you are given $4.40. So you gain by how much? You click here and come to percentage. Just click percentage to 2 decimal places like this, 15,78. And then we are still on cash offer. Then you say gain. So gain attributable to OPAL. Gain attributable to so gain attributable to OPAL. Notice each Thais shareholder got a gain of 60 cents. Remember, total gain is the additional value created. This additional value created is the total gain. That's the total gain, additional value created. Now, of this 719, each Thais shareholder got 60 cents. So value attributable to OPAL, it simply equals, you simply say 719,70 minus 263 shares times 60 cents, meaning value to Thai. So you are saying total value minus the one which goes to tie, the remainder goes to Opal. You get that? The remainder then goes to Opal. So it's a matter of saying equals here. This minus open bracket 263 times 60 cents. So this is the value which goes to tie to Opal, sorry, 561. Of the 561, you have Opal's current value. Opal's current value. Opal's current value is 5,000. They have a current value of 5,000 and they gain 561. So what is percentage gain? So you say percentage gain to Opal. This is now percentage gain to Opal under cash offer. So it will be equals 561,9 over their current value. It's like your current value is 5,000 and you gain 561. What is the percentage gain? So it will be equals to this over this, and then enter, then put it as a percentage. So percentage gain is, okay, so it's 11.24%. So these are the gains under cash offer. You get that? So gain to Opal, gain to tie. All right. So that's cash offer only, because they want you to calculate gain to Opal, gain to tie under each financing option. Under each financing option, please. So here you then say share exchange. So already there you have your 4 marks because they are 12 marks. Share exchange. Share exchange. Now, under share exchange, you have ties current value, ties current value. Remember, it's 999,999,51 like this. And then they are saying you read the exhibits. That's number 2. Through a share for share exchange where a number of ties shares are exchanged for a number of Opal shares, such that 55% of gain created is allocated to tie. So you are simply saying gain attributable to tie. You come here and say gain, sorry, it's either it's my keyboard or it's this, I don't know. Gain attributable to tie, or tie, gain attributable to tie. Now I want you to notice something. This question is 50 marks and it is answered in 90 minutes. You can see that whilst we are learning it, we have almost answered it in 90 minutes. We have almost answered it in 90 minutes whilst we are in class learning. Imagine a situation where you have now prepared for your exam. It will be like fantastic. Now let us finish. Please don't just hang in there. This stuff is so important. Gain attributable to tie, they are saying it's 5.5% times. Remember, the gain is the total gain is the 719.7. That's the gain we are sharing. 719.7. And then, so what you get is equals 0.555 times, that's 55.5. As a decimal is 555 times this. So this would be the gain attributable to TI, which is 399.4. So what is percentage gain? You now say percentage gain equals 399.44 over 999.51. That's percentage gain. So you have it here equals this over this. You put it as a percentage. The examiner wants it as a percentage. So that's 39.96. Actually, you can put it to, if you put it to 2 decimal places like this. Sorry. If you put it to 2 decimal places, it's 40%. Actually, let us put them to 1 decimal place, 11.2, all the percentages, 15.8. Okay, so there you go, 40%. These are the answers the examiner wants. The same percentage gain attributable to. Now, still under share exchange, you then say now if this is disposed, I mean, if this is acquired via share exchange, they are saying gain attributable to OPAO is 44.5%. 44.5%. So we say OPAO's, I mean, gain attributable to OPAO. Okay, sorry. Gain attributable to OPAO. Attributable to OPAO. Attributable to OPAO. It's 44.5%. So it will be equals to 719.7 times 0.445. So gain attributable to OPAO is 320. This is the gain attributable to OPAO. Now, what you need to understand then, is if a subsidiary is acquired by means of share exchange, it means the number of shares of the acquirer increases by the shares issued in exchange. This is so important. The number of shares of the acquirer increases by the number issued in exchange. So you have got value 320, and then OPAO's current value. OPAO's current value is 5,000. Then let me see. I'm giving you shortcuts on this one. 0.27 divided by 5,000. Yes, it's let me not say much. Let me end it, keep it simple. So I will show you how they've done it, say in the marking scheme. So you have here percentage gain. Percentage gain equals, you are now saying this 320 over 5,000, like this, and then the answer that you get to 1 decimal place, 6.4%. So this is the gain they are looking for. Then we have mixed the offer. Mixed the offer. You know, by mixed, you are saying cash and shares. You are being given cash and shares. the mix of cash and shares. So what you are doing here is you are saying ties current share price, current share price, current share price. You want cash and shares. Ties current share price is $3.80. Right. Ties current share price is $3.80. We have calculated it. Right. And then what are they offering? They are saying they are paying cash of $2.09. So what they are offering is they are paying cash of $2.09 and 1 Opower share for each ties share. So for each ties share, you are getting cash of $2.09 and 1 Opower share. So if I may put it in another presentation which works nice and perfect. So on cash offer, it's like this. It's like here is Opower. On mixed offer, it's like here is Opower and here is tie. I have changed the presentation just for you to illustrate it. So it's like cash offered, cash offered, cash offered. You are being offered $2.09 cash, $2.09, and then so let's say you are being let me write under Opower. You are being offered. Will you get this right? Let me do it like this. Let me do it like the way I've said it already. Like ties current share price. Ties current share price. Let me keep it simple. $3.80, and then the cash offered. Cash plus the cash offered plus share plus Opower's share. Opower's share. Now cash offered plus Opower's share is $2.09 plus what is the value of Opower's share? $2.60 here. Opower's share price will be $2.60. So cash offered plus Opower's share, you are getting $2.09 plus $2.60. Let me do it this way. So what do you get? Equals 2,09 plus 2,6. So you are getting $4.69. So what is gain? Gain becomes equals $4.69 minus $3.80, and we have your gain of, don't be surprised with these figures, 89 cents. And then percentage gain, you are simply saying 89 cents over $3.80. 89 cents over always percentage gain is over the current, because you are saying how you have gained by how much. So it's 0.89 over 3,8. That's percentage gain. Now each shareholder of TIE gets 89 cents of the gain. So what is gain attributable to Opower? So it's again similar to this part where we said gain attributable to Opower. So you can copy. Copying is also possible here to save time. You come here and say paste. Right. Gain attributable to Opower. You're saying total gain 719 minus Thai, it's 263 share, 263 million shares. 263 million shares times 89 cents. This time is times 89 cents. What do you get? So you're now saying equals total gain 719.7 minus Thai's value. Value which goes to Thai is 263 million shares for Thai. Each share is getting this gain times 89 cents. 0.89. 89, sorry. So you get the 485 is the gain attributable to Opal. And then you see Opal's current value. Gain is always as a percentage of current, not after the merger. No, current. It's 5,000. And then percentage gain. Percentage gain. Percentage gain, you are simply saying equals this over 5,000. What you get? 9.7%. So you have this. Right. So there you go. What I want you to see is, if I'm to open the marking scheme for this question, you see, I want you to notice something. Let me open the answer. There are various ways this is calculated. And the way it is calculated, some of these will take you years. So if you are to work it out like this, notice our we have gotten all the percentages right. Let us check that. 15.8, we got it. 11.2, we got it. Another percentage was 40%, we got it. 6.4%, we got it. 23.4%, we got it. And 9.7%, we just got it. Right. But there are a lot of intricate workings which are done here, like finding exchange ratio, etc. Like the exchange ratio is 2:1. All these workings, some of all these workings are not even necessary. You get it? So what I want is, it's not given, that because the marking scheme we had it this way. So this is the only way of answering it. The marking scheme is so detailed for all students. It covers all students. So these are the, without all this detail, what for? So challenge with the students is, when they begin to read the marking scheme, they begin to think this was required. Marking scheme is for every student. It is the examiner who is being told that other students, they do it so detailed. So perhaps they failed to get to the answer, but were they on track? But if you know your stuff, what you are simply saying is, I have gained, if I compare my extra to what I have originally, and then just calculate percentage. Gain is always calculated as a percentage of current value. Whatever the examiner has done, some of the stuff is not even necessary. The examiner was just trying to calculate gains like this. This is what the question wanted. Other workings, they are not even relevant. So can you imagine, if you were to type what is there to get the 23.4%, but notice our working, just 3 lines, 23.4%, you have it. Just 2 lines like this, 9.7%, you have it. Because it's a matter of saying gain that I've got over the current value. It's simple as that. You get that? So so you then come to your word processor and complete the gaps. All we want to see here are percentages. So like here you say 15,8. You put another percentage. Here you say 40%. You put 6,4. Allow me to open an Excel workbook. Let me open an Excel workbook. It will open shortly.